Okay, all right. Welcome, guys. All right, so today is an interesting class. So we're going to be talking about identifying the trend, right? So you would have heard that the trend is your friend. So the trend is your friend. And the reason why that statement is said is because it's very true. All right. So, like I've often said in my classes, right? If you want to, as retail traders, what we do is that we follow the money. We follow the money, right? We follow the money. And then we are not, retail traders are not the major movers in the market. Retail traders are not the major movers in the market. So we are not, you and I, the guys that have $50,000, $10,000, $20,000, even $1 million in his account, you're not the one moving the market. All right. So, but what you are looking to do is who is moving the market and how do I follow the money flow in the market? How do I follow the money flow in the market? Okay. So that's why identifying the trend is very important, because the trend is the money flow in the market. The trend is the money flow in the market. If the money is, if the trend is a buy, that means the money is flowing in the buy direction. That's why sometimes you see that it looks as if price is trying to change, it's trying to move in another direction, but it seems like even when the candles are very small, it's still moving in one particular direction because the money flow is in that direction. So once money flow is in a particular direction, you have to understand that trend and flow with it. Otherwise, you lose money. Okay? Otherwise, you lose money. If you don't identify the trend and follow it, you don't make money. That's why we are in the market to make money. So what we do first, when we come into the market, is we want to understand where is the money flowing to? Where is what direction is the money flowing towards? So when we see where the money is flowing towards, then we go in that direction, right? We don't go against it. When you go against the trend, you lose money, you get burnt. We are not in the market to lose money. Yes, losses come sometimes because you cannot understand the market 100% all the time. That's the fact. No matter how good you are going to make some losses. But the most important thing is that your winning trades are far more than your losing ones. You are profitable. That's what profit is, right? Even whatever business you're doing, like even if you're in Nigeria and you are Dangote. Dangote is the richest person in Nigeria. He has all these businesses with trucks everywhere. Many times you find out that trucks are destroyed, trucks are burnt in different places. Yet the company is profitable, but there are losses. You see, there are losses from those trucks, from the bad roads and everything. The truck falls down, the products are destroyed, cement is poured out, and all that on the road. You see them. Yet the company is super profitable. How? Because the company is making far more profit than is losing. And that's what trading is all about. And trading, like I've said before, is a proper business. Okay, is a proper business. So you have to approach it like a proper business. That's why from our previous class, we talked about how you have to understand risk management and all that. You need to know what you are risking per trade. What am I risking on this trade? Am I risking 1% of my account? Am I risking 2% of my account? Am I risking 3% of my account? Am I risking 0.5% of my account? Okay, now that I've decided what I want to risk, what is my reward? Can I risk 1% and make 2%? Can I risk 1% and make 3% on my account? That's exactly how to do. When you start approaching trading like that, that means you're beginning to think like a business person. You see, you become profitable. You begin to think like a business person. And if you've not watched that video, please, the video is in the group. Just scroll over. If you're in this class and you just came in, you don't know where the video is, let me know after the class. I'll repost the video so that you can watch it. So you have to begin to think, we have to begin to think of trading as a business. Those who approach it like a business are those that make money. Okay, so what is my edge? When you come into the market, you're thinking, what is my edge? Like I said, you may not get this 100% of the time, but you need to get it a whole lot of time. You need to get the time you approach the time you get the market right has to be the percentage has to be very high. right? It has to be very high, and then your risk to reward ratio has to be in place. With those two things in place, you can win very well. So when you come into the market, you want to ask, where is my edge? Where is my edge? Okay, your edge is you want to know, where am I going to put my money into that will give me a return? I know that many times as traders, active traders, we don't think like that. But you want to ask yourself, where am I going to put my money into that will guarantee me, or that has a good chance of giving me a very good return on my money? Okay, if I come into the market and I have $1,000 in my account, right, and I want to risk 2%, which is $20, how do I risk? Where am I going to risk this $20 now to make 40? Please mute yourself. Thank you. So where am I going to risk this $20 in order to make 40? That is the idea. That's what you want to look at. That's why we are considering this, right? You want to come into the market. Where do I risk little to make much? Where is my edge? There are times where the market doesn't move very much. For example, the particular pair that I trade has not moved very much, moved a lot last week. I made like Thursday, Friday, market was just moving over 200 pips in 2 days, right? But from yesterday to today, it hasn't moved like that. Okay, hasn't moved like that. So now that it hasn't moved like that, what am I going to do? Am I going to start trading and trying to enter the market? No, there's not much edge. There's not much edge in the market, right? There's not much edge in the market. So what I need to do is I ask myself, okay, looking at this setup now, where am I going to put my money that can give me money? I'm not seeing it. I'm not seeing it. So what? I stay away from the market. Even if I say, okay, let me test the market and see how it's doing. If it's not going the way I want it to go, I close the trade and out of the market because I'm not seeing an edge. I'm not seeing an edge. And the number one edge you want to see in the market is a trend. The number one edge you want to see in the market when you come in is a trend. What is it? What exactly am I? What's going to give me money? Number one is a trend, right? So now there's a little bit of notes I made on the chart. Now the reason I'm doing it on the chart is because I want to be able to write on the screen. So we'll go to that chart now so we can start to understand what a trend is. What are the different types of trends? What's a trend? What are the different types of trends? How do we identify them? Okay, so this class is a little bit fast, but I hope we'll be able to go very far today, but we'll see how far we go though. So let's go to the chart now where I wrote down some things so we can get started from there. All right. Can you see my screen? Can you see my screen?
Yes, I can see your screen.
Okay, great. So if you can see, that means everybody should be able to see. But if you can see it, drop me drop a link, drop a message in the chat. I'll see that. Okay, so now this is the class identifying a trend. So what are the types of trends? We talked about the fact that trend is your friend, and we said why the trend is your friend. Okay, so what are the types of trends? Number one, you have an uptrend. Number two, you have a downtrend. Number three, we have a sideways trend, a range or a no trend. It's basically a sideways trend. You can call it sideways trend. You can call it a range, or you can call it a no trend, whatever it is you want, right? So let's begin to demonstrate this. Let's begin to demonstrate this. Let's begin to demonstrate this. So look at this. Number one, we have an uptrend. So what is an uptrend? An uptrend is a series of higher highs and higher lows. Now, there are a couple of different ways you can understand, you can identify a trend, right? There are a couple of different ways to identify a trend, but then it is always better, no matter the tools you have, no matter the indicator tools you have, it is always better to be able to identify things on the chart through market structure, through price action, through basically what the patterns the market is printing. The patterns that the market is printing is always the best way of understanding what the market is doing. That's always the best way. All right, so that's the reason why we will start from here. We will have other tools that we're going to show about how to identify a trend, but then we'll start from here to understand it from market structure, market pattern. Okay, that market pattern, when you're able to see market pattern, then you'll be able to know when a trend is changing. You can easily know that because it's easier to know when the market a trend changes from market pattern than using indicator. But I'm going to show you an indicator too on this platform that you can easily use to know markets, use to know when a trend changes. But the thing with an indicator is this: it may be lagging. It may be a lagging indicator. Most of the time, indicators lag. And what that means is that the trend would have changed, but the indicator will not show it because it's lagging. It's like it's reading it from the back. It's not predicting. Okay, it's not telling you when the thing is happening. It will now show you after the thing has happened substantially. Sometimes it might show it to you after the thing has almost already passed. That's the reason why you want to be able to understand the trend, understand understand analysis from the position of candlesticks and charts. When you're able to deal with the market from the position of candlesticks and charts, that helps you to understand the market better. So every other thing you want to add becomes something additional, which is good. You can always add whatever you want to add in order to be able to give you confirmations. Okay, so if you have like 2 or 3 things telling you the same thing, then of course you are going to be able to, it becomes easier for you to play there. If price is telling you to buy, if the price pattern is telling you to buy, and then you're also seeing you are seeing a support and resistance there, you are seeing Fibonacci there, that's 2, 3 things, 2, 3 indicators, 2, 3 patterns telling you the same thing. That's what we call confirmation. That begins to give you some confidence that that trade is likely to do well. So let's do something now. So we said an uptrend is a series of higher highs and higher lows. So what does that mean? Let's dramatize it. Okay, so let's look at this. So this is the semblance of a chart, right? This is the semblance of a chart. This is a chart now. Now, this is not a real chart, okay? This is just a tool on TradingView that you can use to mimic charts, like mimic it as though a chart is actually happening. But then, we are dramatizing it now. This is what a chart looks like. Let's say this is a chart right now, and this is candles moving up and down. So now, when we say a series of higher highs and higher lows, what are we talking about? So now, every time you see a chart like this, there is a lower part and there's a higher part. And what I mean by lower part and higher part is this. This is a higher part. This is a higher part of the chart. This is the lower area. This is the higher area. This is the lower area. That's just, it's as simple as that. It's not a difficult thing. The lower side of the chart is called the lows. This point, these low areas, the under chart, if you are on the, whether you're on an uptrend, downtrend, the bottom side of the chart are called the lows. It's just called the lows. While the top part of the chart is called the highs. Okay, so let's so you have these as the highs, and then you have so it's always like this: the bottom, the tops, the highs, the bottom, the lows. Okay, so now let's do something. We said it's a trend line. An uptrend is a series of higher highs and higher lows, right? A series of higher highs and higher lows. So now, since the bottom here are lows, we want to begin to identify. We'll call this point a low, right? We call this particular area here, this is a low. This is a low, but it's a higher low than this low. Okay? Is a higher low than this low. Then this is a low too, but this low is higher than this one. Okay? This is a higher low, this is a low, this is a low, right? This is a higher point, is a higher low than the previous low. That's why it's called a higher low. Then this low also is a higher low than this low. That's why it's called a higher low. So this is like a higher low, right? But then we just call it a higher low. All right. Like I said, the bottoms here are called the lows. The tops are called the highs. The bottoms are the lows. The tops are the highs. Okay. So now we have a low point here. Then a point, you can see that this point now is higher than this point. When you look at it going up, this point right here is higher than this. So it's called a higher low. A higher low. Right? Now this point here is higher than this point, then it's called a higher low. You would have called it a higher low. But you don't call it a higher low, you just call it a higher low. Okay? So take note of that. We are saying higher lows because the bottoms are the lows. And then the more you go up, since it's an uptrend, you see that the lows are getting higher. They are moving up, they are getting higher. That's why we call it a series of higher lows. A series of higher lows. All right, so let's go to the top. Now at the top here, we have what we have a high. We said the tops are all called highs, right? So we have a high here, but when you look at this high, you notice that this high is higher than this one. You see? You see that this high is higher than this one. And then we have another point here, another high here. And then you notice again that this high is higher than this one, right? It's higher than this one. So that's what are we seeing now? We are seeing, because this high is higher than this, we call it a higher high. Because this high is higher than this point, we call it a higher high. Now we would have called this a higher high, but we can't do that. We can only call it a higher high. All right. So now you can look at this. This is what you call an uptrend. An uptrend is a series of higher highs, higher lows. A series of higher highs and higher lows. Okay. So this is a low. This is a low. This is a higher high. A higher high. Sorry, that's not a high. That's not a low. That's a high. This is a high. Okay. This is a high. This is a higher high. Then this is a higher high also. Okay. This is a higher high also. That's a higher high. Okay. So now we have a low. We have a low. Then this is a lower high, a higher low. A higher low. Because this low is higher than the previous one. Then we have this as a higher low too. Higher low. Okay, so this is the definition of an uptrend. Now you will see every time you see an uptrend, you will see this happen. You will see this happen. So now watch this. If after you see it, when you see this happen, you are going to be you enter buy trades. You buy in an uptrend. You buy in an uptrend. Okay. So first of all, we're identifying trends right now. After we now go and start going into the charts to trend is identified on the charts. Okay. So let's pick another one, which is a downtrend. So a downtrend is going to be something like this. Sorry, this is not very clear. Let me delete this and do it again. Okay. Okay, so this is how you identify a downtrend. So a downtrend, like we said here, look at the definition there. The downtrend is a series of lower highs and lower lows. Lower highs and lower lows. Okay. All right. So now look at this. Look at this. We said the tops of the chart is always the high. The top is always the highs, and the bottoms is always the lows. The top is the high. The bottom, the lows. The top is the high, the bottom the lows. All right, so now the same thing here. The top is the high, the bottom is the low, right? So this top here is also the highs. Let's bring this here. So this top here is the high. Okay, so we have a high here. This top here is basically the highs. Then this bottom is basically the lows. Okay, the highs, the lows, fine. So now, because we are seeing the highs here, let's begin to mark up now. Let's look. So this is a high, right? Where's my pen? Okay. So this is a high, right? This is a high. Okay, so this is also a high. This is also a high. And this is also a high. But notice, you see that these highs are depreciating. They are coming down. They are coming down. They are coming down. Okay, so this high is lower than this high, so we call it a lower high. This high here is lower than this, so we call it a lower high. This high too is lower than this one, so we call it a lower high. This low is lower than this, so we call it a lower high. So now we have a high here. We have a high. So we have a lower high. Lower high. Then we have another lower high. We have another lower high. Then we have yet another lower high. Okay, so this is how you arrive at a series of lower highs, right? So at the bottom here, we know that the bottoms are called the lows. We know the bottoms are called the lows, right? Okay, so now this is a low here. This is a low point because the bottoms are called the lows. Now you notice that this low is also a low. This area is also a low. This area is also a low. This area is also another low, right? But notice that these lows are coming down. These lows are coming down. These lows are coming down. So this is called a low. This is called a lower low, a lower low. This is called a lower low. And this is also called a lower low. Why? Because the lows are higher than the previous lows. This low is lower than this low, so it's called a lower low. This low is called lower than this low, is called a lower low. This low is called lower than this low, is called a lower low. This is how you identify trends on the chart. This is how you identify. This is the market pattern way of identifying your downtrend on the chart. Now, this is the best way to identify your downtrend and uptrend. This is the best way to identify it. Like I said before, indicators can help you to identify the trend, and we're going to see some of that. But this is the easiest way this is the way you can identify a trend on the chart, and you can get in at the right time. Many times, if you're using an indicator like a 50 MA, which we are going to see, you will see that when the chart starts to tell you, sometimes when that indicator starts to tell you that trend is changing, it has already gone very far. And in some cases, it's not even accurate. In some cases, it may not even be accurate. In some cases, in several cases, it may not even be accurate. The change trend you are seeing at that time may not be accurate. It may be a false signal that the indicator is giving you. But if you understand the market and you are able to see these things on the chart yourself, you are able to understand the market, see these things on the chart yourself, it's easier then for you to be able to look at it and know when there is a potential change in trend. Okay, so now let's look at it. Then the next one is what we call the what we call the no trend, right? We call that the no trend or sideways trend. So let's look at the sideways trend. So sideways trend is it's usually like this. Okay. So this is what you see with a sideways trend. A sideways trend is not really going up or going down. It's not trending, it's not going in a particular direction. Yes, you see price going up and down. Price is going up and down, but you're not seeing price going in a direction. Remember, if you're not seeing price going in a direction, that means there is no trend at that time. That's also one of the reasons why this pattern is called a no trend. That's one reason it's called a no trend. Market is not going up, it's not going in a particular direction at that time. And the truth is that this is not the best time to trade. This is one of the worst times to trade. Because if this pattern you are seeing here is usually very short. And then what happens is price will usually break out. Price will usually break out of this. Price will usually break out of this. When price breaks out of this, then price is likely to go up. Or when price breaks below like this, and price will usually go down. That's what you need to wait. That's what you need to be waiting for. Whenever you see a sideways trend, you are not meant to be trading. You are meant to be waiting. You're meant to box the price. Just box it the way I've done it here, and you are waiting for a breakout. Breakout is what you are waiting for whenever you see a sideways trend. It's really a no trend. It's sideways movement. Let's just call it a sideways movement. Whenever you see a sideways movement like this, you are going to wait for it and you're waiting for a breakout. This morning I was seeing something where someone was talking about. He said most of the time, he says 90% of the time in Forex, what we do is we're waiting. 10% of the time is when we are executing. 90% we are waiting, right? And if you cannot wait, one thing will happen is this. One thing will happen, if you cannot wait in the market, you will usually lose money. If you cannot wait, if you have not developed capacity to wait in the market, you will usually lose money because you are going to put your money into setups that are suboptimal, that are poor quality, right? That are poor quality. So the way we look at trading is this. You want to be able to come into the market and you want to ask yourself, what kind of setup deserves my money? What kind of pattern deserves my money? Now, if you want to invest in something, that's why I said, when you begin to look at trading like an investment and like a business or an investment, you begin to have a different approach to it and you begin to get results. I still keep emphasizing the last class we had that had to do with money management, how to allocate your capital to trade in terms of risk to reward and all that, determining your risk per trade. It's absolutely important. I can't emphasize it well enough. So if you are in this class, you've not had that, you've not gone through that class, please go to the chat and look and just scroll. It's not far away there. And if you are new to this class, and just let me know, maybe by chat later on after this class is done, I will repost it to the group so that you can go back and watch it. Because when you start to approach the market, you think like this, think about this. Let's say you are a merchant and you want to invest your money in a particular deal. You're looking for a particular deal to put your money into. Are you going to put your money into a deal with a low risk, with a low potential but high risk? Or you're going to put your money into a trade, into a business, into a deal that has low risk but high reward? Of course, there's risk in everything, but where are you likely to put your money? Low risk, high reward, or high risk, low reward? Obviously, you want to put your money into a deal that has low risk, high reward. Low risk, high reward. Not no risk, low risk, but high reward. That's what you want to be able to do as an investor. You want to put your money and say, oh, that's why some investors, what they do is they invest in early stage startups. because they know at that time the risk is low, but the potential is literally limitless, right? Let's say there are people who put in $10,000 into an investment, let's say startup investment, that eventually turn into millions, turn literally into millions, sometimes into billions, right? Why did that happen? The low risk, if that person is an investor and he lost that 10,000, it won't bother him that much. You can invest another one in another business, right? But those are going to be investing, and those are investing later on. Series A investment, Series B investment, and all of that, right? If you know a bit about venture capital and all that, that's what I'm talking about. So by that time, those ones are investing millions of dollars. Their risk is now high. But imagine the guy who put in 10K when they were starting. The risk is low, the reward is crazy. In fact, by the time other people are investing, this guy is already making millions. The one who invested at early stage. So that's how you want to think about setups in the market. You want to ask yourself, this setup, does it deserve my money? Should I invest in this setup? Is the risk on this setup and compared to the reward, is it good enough for my money? So this is the reason why you want to wait. When you see a setup like this, and you know that, okay, if I sell here, I most likely will make some money. This could be 10 pips. This right here, from top to bottom here, could be 10 pips. If you buy from here to here, could be 10 pips. But you're asking yourself, how do I put my money? If I'm going to put my money into this now for a reward of 10 pips, what's going to be my risk then? If my goal is 10 pips, what is then my reward? If my reward is 10 pips, what is now my risk? My risk can also be less than 10 pips. My risk might even be more. There are people who you will see trading, their stop loss is much bigger than their take profit. Now, if your stop loss is much bigger than your take profit, and you take that kind of trade all the time, and that's your strategy for trading, it takes 1 or 2 trades for you, 1 or 2 losing trades to wipe out all your profits. It will take 1 or 2 losing trades to wipe out all your profits. You are not thinking like a business person. That's why your stop loss is bigger than your take profit, right? But the setups is what determines that. If the setup is good enough, then the setup can give you a good risk to reward ratio. So what will happen here is that by the time you measure from here to this bottom here, and you see that it's giving you 10 pips, or you see that it's in a range like this, the range is so small. Yes, you know you can sell from here and make profit here. You can buy from here and take profit there. You know, but you've seen that the risk is very low. The risk is high compared to the reward is not there. The reward is low rather. The reward is low compared to the risk you are taking. So you ignore this kind of setups. So when you see price in the range, whether you're trading intraday within the day or you are trading in larger time frame, you want to look at a trend that is sideways like this, and you want to wait for a breakout. When it breaks out, it can go to 50 pips. It can go to 100 pips. That's where you want to put your money. You see? So this is why you want to identify a trend. You identify the trend, so you know the different kinds of trends. When you see this, you know that there's only one outcome. It's going to have to break out for you to trade. If it doesn't break out, you're not going to trade it. If it doesn't break out, you're not going to trade it, right? So very, very, very important. Now, like I said, this is the best way for you to identify these setups in the market. Okay, so let's look at, okay, so now market pattern. I say here are some ways to identify trends. So market pattern. Now, what we are going to do next is that we are going to try to find a chart where we can try to identify a trend. Identify a trend right now. So we said there are 3 different ways we can identify. Now, there are more ways than these 3. But what I'm hoping to do is to be able to go through these 3, probably in this class, and then we'll be able to then we'll be able to do some other ones in another class, right? So let's start with the first one. Let's go to the chart and try to use market pattern to identify this one we've done now. Let's try and see if we can go to the market and identify what's going on. Let's see. Can we find a chart that can help us to see what trend is happening in the market? What trend is there? Okay, so let's look at this. So this is Euro JPY. This is Euro JPY. Incidentally, Euro JPY just had a major downtrend. It just had a major downtrend. So that's why we are seeing this right now. Is a major downtrend. Okay. So now when we talked about lows and highs, these bottoms right here is what we call the low. This point right here is what we call the lows. Here's the lows. Lows. Then on top here we have the highs. On top here we have the highs, right? Okay, so we have the lows here, we have the highs here, right? So now what it is that you want to know what trend am I in. We said higher highs and higher lows, higher highs and higher lows. Now look at this point. So we have a high here. You see this high is lower than this high, this one. This high here is also lower than this one. This high here, this area here is also lower than this. So basically you can see, then from here, this bottom, this is the low here, okay? Now this low is lower than this low. This low is lower than this one. So we call that a lower low. Lower low. So now look at this low is lower than this one. We call that a lower low. Then we see this low again. We see this low is lower than this low, and so we call that a lower low. So we have identified a downtrend right now. We have identified a downtrend. This is the way to identify a downtrend. Okay, so probably we'll do like two things together. Now, another way to identify a downtrend is by using indicators, by using an indicator like a moving average. That's what we have there. That's the number 2 we have. And identify like a moving average. Like what we have on this chart, what I have on this chart now is a moving average. Okay, so moving averages are certain kinds of indicators that help us mostly with trends. They help us to identify trends. We want to know whenever this indicator, whenever price is under it, it means that you are in a downtrend. Whenever price is above it, it means that you are in an uptrend. Okay, now it does not work all the time. That's why I said the best way to do it is to use market patterns. Market patterns is the best way to do this. It does not happen all the time. Most of the time, when it gives you a certain setup, it might be wrong. When it gives you a certain movement, most likely it will be wrong. You see, so sometimes is right when the trend continues for a long time. Just like this one, now you can see this move down now, very heavy sell-off. Now, when you use the moving average for this kind of movement, it gets it right. But by the time you look at this now, look at price is supposed to be like a downtrend when price is under it. Like price is under it here now, that's a downtrend. When price goes above it like this, it's supposed to be an uptrend. But the truth is that this downtrend is not done yet. This overall downtrend has not changed yet. But temporarily, it changed here. Temporarily, it changed here, but it has not changed fully. All right. So now let's watch something here. Let's look at something. So you notice that this trend was continuing down like this until this happened. Until price got out of this area, got out of this higher low, price left it. Price broke out of it. Can you see? When price got here, it came down, touched it, came down, touched it, came down. Look at what I mean here. So you see this, price got here, came down, came down, came down, just kept going. But what happened here? Price broke outside of it. So when price breaks out like this, what that tells you is that the change is temporarily changing. The trend is temporarily changing. That's what price is telling you there. So when this happens, what you start to look for is you start looking for a pattern to enter in the next direction. You know that this is a downtrend. So if a downtrend is broken, it means it's resuming an uptrend. If a downtrend is broken, it means that it's resuming an uptrend. Now we're going to go deeper into this analysis and all that in subsequent classes. But these are just basically, I'm just exposing the concepts to you guys now. We will use it more in consequent classes. We will have class where we'll just come here and all we'll be doing is identifying top and identify uptrends, downtrends, and all that. Probably that's what we'll do on our next class. Identify uptrends, downtrends, how they break, and all of that. Okay, so basically for this one now, you see how he broke out of it, and then the trend changed. But when the trend changed, look at it, the trend changed around here. But this indicator is still telling you that it's a downtrend because the candles are still under it. So it's still telling you that it's a downtrend until it got to this point and it broke out of it. And in this trade, actually, this is still an overall downtrend. It's an overall downtrend. When we go to a higher time frame, you realize that this is still an overall downtrend. When we go to a lower time, a higher time, this is a daily time frame. You will see that it is still a downtrend. Totally, it's still a downtrend. Okay, so if this trend is showing us here. This trend is telling us here that is an uptrend. This indicator is basically a bit of a false signal, But then there is a change. Once price broke out of this area, it changed the trend. But this trend change is temporary. But then as a trader, you are not bothered so much about whether a trend is temporary or not. What you do is you identify a trend, you trade it for as long as it lasts. That's your job is to trade a trend for as long as it lasts. Capitalize on it, take your profit and you're out. You wait for the next one. Capitalize on it, capitalize on it, take your profit and you're out, you wait for the next one. But then it's important as you are doing that, as you are taking advantage of the minor changes in trend here and there, it's important that you have an overall view of the overall trend. You have an overall view of the overall trend. So this is one reason why we look at fundamental analysis. Because most of the time, this trend we are seeing here right now, this sales trend we are seeing right here right now, it happened when a fundamental event happened. So some people, when we're talking about fundamental analysis, we are saying, oh, the news is going to come out. There's the Federal Reserve is doing this. The central bank is doing this. The non-farm payroll is coming out. There's CPI, there's inflation. Some people say, please stop disturbing me. I don't want to know all those things. I just want to make money. But the way to make money is basically to know all those things because those are the things that changes the trend of the market. If you traded USD pair, any USD related pair last year, from March to somewhere around November, the market was just a buy. In fact, you could even buy at any point and just go and sleep. Just buy, just place a buy, one standard lot and go and sleep. Come back in 2 months' time, you'll be in serious profits. That was how the market was last year for USD pairs. Pairs that have USD as base currency, like USD JPY, USD CAD, USD CHF, those pairs. All you need to do, just buy anytime, any point you like, just buy and forget about it. Come back in 2 months' time, you are in serious profit. That was how it was. You didn't need to analyze the market very much. It was an uptrend. It was just buying, right? So, but what changed it now that it has started selling? Fundamental events. Fundamental event was what changed it. That's why we keep our eyes on fundamental events. Okay, so let's look at something else right now. Let's look at something else. All right, look at this. Okay, so right here, what you're seeing now inside this box is what you call a sideways movement. Sideways movement. So it's, of course, it extends like this. Is what you call a sideways movement. Sideways movement. So when price is in a sideways movement like this, you don't touch it, you don't trade it, you leave it alone. That's what you do when price is in a sideways movement like this. You leave it alone. That's what you're saying. That's what I was saying. So what you are waiting for is a breakout. When price breaks out, then this is what you call a breakout. You see this huge red candle now? That's a breakout. When it breaks out like that, what happens is that it's going to continue to sell. It's going to continue to sell. And you can see the massive sell now that happened. Massive sell that happened. And this sell is not done yet. This is from that point now to this bottom is about 69 pips. Okay, 66 pips, 66.9 pips. You can see there's 66.9 pips. That happened within a very short period of time. So now what is basically happening now is that price is trying to push to this area and sell again. So even if you did not enter this trade that time, you can enter a trade at this area right now, at this area. When price gets to this area, let's look at it. When price gets to this area, you are going to be able to enter this area for a sell. From this point where I put this line, now you're going to be able to enter and you're going to be able to sell this for close to 60, 70, 80 pips. And the reason why you can do that is because price has broken out of this range right here, right now, this range. So whenever you see a range, you want to box up that range and wait for a breakout. Box up that range, wait for a breakout. Okay, so that's what we are seeing here now, a breakout happened around here, and then you can see the price just move down significantly. Okay, so here's what we are going to do. This slide is kind of a bit vast, and we are going to be doing more, going into the charts more in the next class. So here is what we are going to do. This is more like something that you should do, like an assignment or something, but it doesn't have to be like an assignment. You are not in a formal class here, right? But then this is something that is very important for you to do. If you do it and you want to show it to me, that's fine, right? So what you need to do is go to your charts and try to identify a downtrend, an uptrend, and a sideways trend. Just identify as many as you can, because here is the thing with these trainings and analysis. When you get a training, that's usually sometimes is actually less than 10% of what it takes for you to become good in this thing. Is actually the training you get is probably less than 10%. The practice is over 80%. When you practice this thing, you will get it very well. There's a young guy I did some trainings for, right? He's like 17 years old. I did some trainings for him, and he really began to practice this stuff. And that boy is making money right now. I think he's just trying to get into university. He was showing me charts, showing me withdrawals that he has made, thanking me for the classes I've been taking him through, right? So what I'm trying to say is that what I did was I took him to the concept. I said, go and practice, go and practice, go and practice. I tell him, go and practice. Sometimes he will send me charts. Should I enter? I say, analyze it and enter. And then don't be confident when you have done your analysis, right? He started entering his trades. So what I'm trying to say is that you have to go on the chart. If you're in this class, go on this chart yourself after this class. Go on the chart after this class and begin to identify these points. On our next class, we are going to go back into the chart again. Then we will not have to go through what we've gone through now already. We will go into the charts, and definitely we're going to be identifying support. We're going to be identifying trends, up trends, down trends, sideways trend, and we will use it to begin to analyze the markets. Now, we're not doing any analysis here, but we're going to be using this concept we have learned now to analyze markets on our next class. Okay, so if you have gone through some of these now, and if you're able to study on your own right now, which means you're able to go on the chart, identify up tops and bottoms, identify trends, identify downtrend, uptrend, right now, you'll be able to flow better. on the next class. Okay, so we're going to pause this class for now, and then we are going to take some questions, and then we'll continue. Okay, so there are a couple of ways to enter once you have seen a breakout of a sideways trend or a sideways movement. Okay, so one of them is you want to trade, you enter in the direction of the market when price retraces to the structure that was broken. So now here's what I'm saying. Now you can see that before this red candle happened, this blue line here and this blue line here, this blue shade here, constituted the structure, the sideways movement. So the sideways movement happened inside this point. So we had what we call a supply zone here. Sorry, a demand zone here. Demand zone is also known as support. There on top here, we have a supply zone, which is also known as resistance. Okay, so if you don't know what support and resistance is, or you don't know it deeply, probably we'll have to touch that a bit on the next class before we proceed. Okay, because that's going to be also some do have some understanding on that before we can use it, right? So we have a support here, we have a resistance, right? We have a support here, we have a support here, we have resistance on top, right? Fine. So when price breaks out, there are a couple of ways you can enter. Your price may come to this support that it has broken. Usually that's what's going to happen. It will come to this support that it has broken. This is where you now enter for a sell. So you wait, price breaks out like this. No, you don't jump in yet for a sell. So you hold on, you wait for price to come and test this, the support that was broken. You want it to come and test it, touch it. So you come to this point now, price pushes to this point, you now enter for a sell at that point. That's what you have to wait for. You have to then wait for this area for price to come here and pull back from there. That's what you're waiting for. That's one way to do it. And then also, the best way to do this is to use confirmations. If you notice now, you notice that we're expecting this price to come here and then sell, right? But we also notice that this trend, this moving average is also sitting at that point. The moving average is also sitting at that point. That's the second confirmation. It's telling you that, oh, it was broken here. Most likely it's waiting for price to come and touch this place before coming down again. You see? So that's the second Fibonacci. Fibonacci is actually one of the most accurate tools that you can use. So here's what you do. We will discuss this more in the next class. I'm doing this purposely for the person who asked this question. You take a structure here, a high, a recent high, you take the low. You take a recent high, you take a recent low, the most recent highs and lows. Guess what? You are looking for a point that falls at this area of 0.5 or 0.61. You notice now that 0.5 is also sitting at the same area where we are expecting price to come down from. Right? So look at now, we're having three confirmations. Number one, we're expecting price to come down from here because that's the structure that was broken. Number two, we are seeing that this moving average passed through that place, it broke out, and now we're expecting, see this moving average is sitting at this point, sitting quietly there. What else is also telling you, whenever price breaks out of a structure, it goes to test it on its way down. When price breaks out of a structure, whether it goes up or down, in this case now it broke out of the structure, it's going to go and retest it, retest that area, it's going to go and retest this area and come down again. This is going to be your entry now. This is your entry. And now we've used three tools here. We use the support, we use your moving average, we use Fibonacci. Everything is telling us that price is reversing at that same point. So in this case, now if I was ready to take this trade, all I will need to do is wait for this trade, wait for price to get to this point and sell from here. And then here's what I will do. I will enter this trade from this point. this area here, I'll put my stop loss above this, above the 61.8. I'll put my stop loss above, which is probably around 30 pips. I'll put my stop loss at 30 pips, also 25, 30 pips. Then I will go for take profit. Take profit, I will usually come and take the take profit here for 60 something pips. This is how we do this now. So this trade is going to be for me at least a 1 to 2 risk reward. So my risk is going to be somewhere here for 30 pips. So my risk is going to be this. Let me show you guys this. Sorry. What is this? Okay. So this is this for a buy. Let's remove this one. This for a buy. We should do for a sell. Okay, so this is for a sell. Okay, good. So we're expecting to enter at this point for a sell. And we want to make it like 30 pips or so. Let's check 30 pips. Okay, so this is somewhere around 30 pips. Okay, then we are expecting to see a reward of about 60 pips, 60 pips. So this is the way I will take this. This is the way I will do this trade. Okay, this is the way I will do this trade. Is which time frame should we use as a yardstick for breakout? I will advise 1 hour. 1 hour is good. 1 hour is good, right? I do mine on 1 hour. So that's what I will advise you to do on 1 hour, right? So this is how I will place this trade. This is how I will do this trade exactly. Okay, so do we understand that?
Oh, yes, I definitely can.